How do you know if a dividend stock is actually worth buying? In this video, I'll walk you through a simple step-by-step process to analyze any dividend stock. If you want to build long-term passive income, you'll want to watch this all the way through. If you're just getting started with dividend investing, or even if you've bought a few stocks already, it can feel overwhelming to figure out which companies are truly reliable for the long run. There are hundreds of choices, and not all dividend stocks are created equal. Some pay high yields but aren't sustainable. Others might look boring but are actually steady income machines. The good news is you don't need a finance degree or hours of research to get started. By following a clear process, you can quickly filter out risky stocks and focus on companies that could help grow your passive income year after year. In this video, I'll break down 5 simple steps to analyze a dividend stock. I'll also explain some key terms along the way, like dividend yield, payout ratio, and diversification, so you'll feel confident putting your money to work. As always, remember, this is not financial advice. This video is for educational purposes only. Be sure to do your own research before making any investment decisions. Let's jump into the 5 steps. Step 1, look at the dividend yield. The first thing most people check is the dividend yield. But what does that actually mean? The dividend yield is a simple percentage that shows how much cash you'd earn from dividends each year compared to the stock's price. For example, if a company's stock is $100 per share and it pays $4 in annual dividends, the yield is 4%. That's just $4 divided by $100. You might be tempted to chase the highest yields you see, but be careful. Very high yields can actually be a warning sign. Sometimes, a high yield means the stock price has dropped because the company is in trouble and the dividend might not be sustainable. A reasonable dividend yield for most stable companies is usually between 2% and 5%. That might not sound exciting, but over time, those steady payouts can really add up. Let's use a real-world example, Johnson & Johnson. As of early 2024, the stock trades around $155 and pays an annual dividend of $4.76 per share. That's a yield of about 3%. It's not flashy, but it's consistent, a good starting point. Step 2, check the payout ratio. Next, you'll want to check something called the payout ratio. This tells you what percentage of a company's profits are being paid out as dividends. In simple terms, is the company paying out more than it can afford? To calculate the payout ratio, you divide the annual dividend per share by the company's earnings per share. If a company earns $5 per share and pays a $2 dividend, the payout ratio is 40%. A payout ratio between 30% and 60% is generally considered healthy for most industries. It means the company is keeping enough profits to reinvest in the business while still rewarding shareholders. If you see a payout ratio above 80% or even over 100%, that's a red flag. It means the company might be stretching to pay the dividend and could cut it if profits drop. Let's go back to Johnson & Johnson. Their payout ratio is around 45%. That's a good sign. They're not overextending themselves. Step 3, look for dividend growth. It's not just about how much the dividend is today. You want to see if the company has a track record of increasing its dividend over time. This is called dividend growth. Companies that regularly raise their dividends are showing confidence in their future earnings. Plus, a growing dividend helps you keep up with inflation and builds your passive income over the years. A great example here is Procter & Gamble. They've increased their dividend for over 65 years in a row. That's a sign of a durable business. Even modest annual increases can make a big difference in your long-term returns. You can check a company's dividend history on most financial websites. Look for at least 5 to 10 years of consistent or growing payments. Step 4, evaluate the company's financial health. Before buying any dividend stock, take a quick look at the company's overall financial strength. Is it profitable? Does it have manageable debt? Is its business stable or shrinking? You don't need to dig through pages of financial statements. Just check a few basics. Is the company consistently profitable? Are sales and earnings steady or growing? Does the company have a history of staying out of major financial trouble? Let's look at Coca-Cola. This is a company with a strong global brand, steady profits, and a long history of paying and raising dividends. That's the kind of financial foundation you want supporting your passive income. On the other hand, there are companies, often in industries like energy or retail, that might have high yields but unstable businesses. If profits are falling or debt is piling up, the dividend might not last. Step 5. Diversify your dividend portfolio. Finally, remember the importance of diversification. Diversification simply means spreading your money across different companies and industries rather than putting all your eggs in one basket. Why does this matter? Even the best companies can hit tough times. If you only own 1 or 2 stocks, a dividend cut or business problem can have a big impact on your income. By owning a variety of dividend stocks in different sectors, like healthcare, consumer goods, utilities, and tech, you reduce your overall risk. For example, you might own shares of Johnson & Johnson Healthcare, Procter & Gamble, consumer products, and PepsiCo beverages. If one industry struggles, the others can help balance things out. A simple way to diversify, especially for beginners, is to consider a dividend-focused ETF, which holds dozens or even hundreds of dividend-paying stocks. But even if you pick individual stocks, aim for at least 8 to 12 companies in different industries as your portfolio grows. Recap and summary. Let's quickly recap the 5 steps to analyze a dividend stock. First, check the dividend yield, but don't chase the highest numbers. Second, look at the payout ratio to make sure the company isn't overextending itself. Third, look for a solid track record of dividend growth. Fourth, assess the company's financial health with a quick check of profits and stability. And finally, diversify across several companies and industries to manage your risk. By following these steps, you can filter out risky stocks and focus on the ones that are more likely to provide reliable, growing income for years to come. Remember, dividend investing isn't about getting rich quick. It's about slowly building a stream of passive income that can help you reach your long-term financial goals. I hope you found this guide helpful. If you did, please consider liking the video, subscribing to the channel, and leaving a comment below about your favorite dividend stock or what topics you'd like to see next. Thanks for watching, and happy investing.